It's Friday. It's very hot in Virginia. I'm cutting 20 acres of grass and running a large-scale antique business at the same time. I'm a swing trader trying to get the tops and bottoms and the trend in between. And it fits my lifestyle, which I can't afford to sit in front of a computer all day. Today we're going to talk about Johnson & Johnson, a very, very great company. The snowflake is big and green, which says it's a healthy company. It pays a dividend. It's undervalued. The future maybe is looking a little tough and has some great solid past. Before we jump in, I want to remind you that the Stock Planner channel is an education channel. We're sharing our ideas. I'm sharing my trades with you so that help you learn. I wouldn't recommend copying anything. In fact, I wouldn't copy anybody that's promoting their trades on the internet. And as I told you, in my case, I have other concerns in businesses. But I love the stock market. My degree is in computer science, and at one time I thought I could beat the market by writing a great program, but that's not possible. You have to do some fundamental analysis. That's what we're going to do now. We're going to start out with fundamental analysis, look at the chart, and see if it can have a trade. I always like to do options because I think it minimizes risk, and I'll show you that trade. What alerted me to Johnson & Johnson over the last 7 days, it really has jumped this stock price. But over the last year, it has been having some trouble. Johnson & Johnson is a healthcare company. It offers a wide range of healthcare products. It operates in all or a lot of countries worldwide. It operates worldwide. It does baby care, skin care, wound care products. It does some work in infectious diseases, orthopedics, heart disease, and diabetes. They're into a lot of stuff. Johnson & Johnson is currently trading at 33%, 35% below its fair value. I'll show you that in a minute. Earnings are forecast to grow by 13 or 14%. Earnings grew by 17% over last year, and it pays a dividend of about 3%. As a swing trader, I'm not concerned about the dividend. Why I like dividend stocks sometimes is they tend to move in a steadier state. According to Simply Wall Street, the current price is $155.42, and it should be trading at $240. So typically, if you see that, you'll say, hey, this stock is undervalued. When people find out about that, the price will tend to move up in that direction, and that's true. The revenue and in earnings, you want that to be going in an upward trend, and it is. Here's the industry, and this is what the analysts are predicting for the company, and that you want to see this a little higher than the industry if your stock is going up. Likewise for revenue growth. And the analysts are saying, hey, this stock is going to go up 14% over the next year. So it'll be trading in this area here at about 172. It's currently at 151, 155, I think it said. And when you're looking at financial health, you want the assets to cover the liabilities, and it does. And long term, they're in a better position. And it pays a reliable dividend, currently at 3.2. Great undervalued company, but I'm looking to maybe take a short-term short. Let's look at the technicals and the chart and see if we can validate that premise. This is a past trade, a very successful one. I've been trading it a lot. And I like it because it swings a lot, and it swings long. In other words, if you took a short up here, it'll stay short for a few weeks and a month. And likewise, if you take a long, based on the zero lag or the RSI, here, it's going to stay above that for quite a bit of time. And that's great for option trading, when you're trading time for money. So if we took a trade here based on zero lag or the RSI, that would have been a long-term trend. So here we got the RSI above the 70. Some people consider that a signal to go down. We just had earnings, and they were good, very good, but there was some new guidance. They've loaded guidance for their future growth, and it outlines several challenges the company is facing. The analysts are still showing this is a buy, and this is in TradingView. It was about 10% growth for the year. yesterday. We have a red bar. I have no idea. Seems like we have a level of support in this area here, around the 143. It seems like we have a level of resistance, maybe at that level right there, 153. But it spent a lot of time in between those two levels. And that's, I think, where the stock wants to be in, somewhere in that area for a little while. At least till the election's over. Because it's a good company, and because I want to go short, I don't want to go short for too long. Let's see if there's a trade that can capitalize on my theory that this stock is going to retrace a little bit. And if you believe in the 50% retracement rule, it would trace down in that area there. So I go to Option Strat, which is a simulation tool. You simulate your option trades. It's free. I'm using the free version at the moment. And I want to go short, and I want to go short for not too long. And here's my options here, and I can look at the amount of risk. You could buy a long put with a risk of about $228. I like a broken wing a lot of times, but the risk today for their recommended trade is $925. That's a lot. And bear call spread. That's a simple thing to do. And I've got to mow the grass, so that's what I'm going to do. I'm going to do bear call spread. And you can see that their recommended trade, you'll need $1,000 worth of margin, and immediately in your pocket you get $600. And the max loss on this is $400. So if you have $1,000, this is the one to do. And if you have not so much money, you can roll this down here, and that should take this down to 500 margin, but it also takes your credit down. So this is not quite 1-to-1. Your break even is 157.21. They're already winning a little bit. This trade is going to last 28 days. I think this is going to be a fast trade, and I'm going to take the risk. The better trade is this one. Your risk to reward ratio is better, but you need $1,000 worth of margin. And you need a margin count for most option trades. And you can see the range down here is only about 5%. This stock is not going to move a lot. Break even is 157.21. And we're going short. I'll take my short position thing here. 157.21. That's close enough for government work. Roll it down. Now we have to set the date correctly. August 16th. Now this is trading. Is this stock going to continue up? Is there a level of support right here? Or resistance right here? It very well can continue going up. Or did you see this long bar here based on earnings? Everybody's excited. Great earnings report. And after the excitement wanes, will it come back down this way? That's called mean reversion trading, where stock will reverse to its mean. Here's your 50% retracement. Will come back down to that level. It often happens like that, especially when you have a nice long trend up there. It retraces about 50% and continues on up. Well, that's the trade I have for you today. A bear call spread on Johnson & Johnson, staying in this range here. As long as it stays below 157.41, we have a winner. Gotta stay below that. This is based on the RSI being overbought, based on that excitement from that report. The zero lag hasn't crossed over yet, but it looks like it's about to. And I may be early. I'm early a lot. But because I trade options and trade 1 month, 2 months, 3 months out, being a little early doesn't hurt. If you're trading on a hourly, being too early is very much more hurtful. All right, like what you do your own due diligence, learn it and win. It's Friday. There may be some turbulence in the market. We'll catch you on the flip.